If you are confused by the current housing market, you are definitely not alone and you're in the right place. Because as the housing market continues to cool, it's also starting to show signs of stabilizing. So in this month's real estate market update, I'm going to dive into that, help explain exactly what that means and how it impacts you if you're considering buying or selling a home. Hi, this is Andrew with the Andrew Smith team in Frisco, Texas. And without a doubt, the only certainty in the housing market right now is the uncertainty of it. I mean, even the experts aren't quite sure which way it's going to go because the housing data is changing. It's changing constantly. And my goal each and every month in these real estate market updates is to share that latest data with you so that you can make the best decision for you, because that's what matters most. There's a lot of people out there hoping the market will do one thing or another that's basically based on nothing. It's wishful thinking. And my goal here, as I mentioned, isn't to interject any of that into it. It's just to share the information, right? So that you can do what you need to do. And everyone's situation is different. So today we're going to focus in on home prices and inventory as they are directly related. And those two things are what brought us to where we are. So let's look at that for just 1 second. So it all comes down to supply and demand. I've said this repeatedly over and over and over. If you've seen any of my other videos or even my weekly updates that I also do, and there's been a lot of comparisons to 2007, 2008, and this is nothing like that. And I know you've heard that before, and many people agree with me, and a lot of people don't. That's fine. But the fact of the matter is, back in 2007, 2008, you had a situation that didn't make any sense at all. What I mean is, you had home prices going up astronomically fast, but you had plenty of supply. The prices going up didn't make sense considering the level of demand we had relative to the supply of homes that was available. We had a lot of demand that was being artificially created by the mortgage industry. I mean, it was the financial markets, the mortgage markets in particular, that caused a lot of problems with predatory lending. Well, all of that is gone. That doesn't exist in today's market. We've got a situation where all of the loans that have been made for much of the last decade have been standard, regular finance loans. You could argue that the pendulum swung too far to the conservative side and that it was really, really hard to get a loan. I know plenty of people that were more than qualified to buy a home that could not get a loan in the years following the crash. So that is not what's happened here. But I think we can all agree that what we've experienced for the past 2 years was unsustainable. Home price growth that we've seen was not sustainable. Affordability is a major issue for many people. And so something had to change, right? And it's changing right now. But when you look at that, how did that actually happen? I mean, we had everything shut down as a result of the pandemic. And many people at that time said housing's doomed. The market's going to crash. Unemployment skyrocketing. Everyone's going to get foreclosed on, et cetera, et cetera. And as we know now, none of that actually happened. But what did happen is two things as a result of the pandemic. Even though the Fed doesn't directly control mortgage rates, it can influence them. And Fed policies at the time, which were extended for quite a long period of time, basically artificially pushed mortgage rates down. As we know, mortgage rates were in the mid to high 2% for a 30-year fixed rate mortgage. That's not sustainable. That situation, just like really high home prices, is not sustainable. It can't continue that way. At the exact same point in time, you had the pandemic creating demand as remote work absolutely took off. So you had people moving across state lines. They could work from anywhere. They were taking higher salaries, buying in more affordable places, and demand shot up. At the same time, supply is very low, right? Supply, we've been underbuilt for over a decade. Supply has been constrained. And so eventually, though, we reached the breaking point. Right? We saw that. I mean, and what triggered it is the rise in mortgage rates. So mortgage rates started to go up earlier this year. And what did it do? It took the air out of the buy side of the equation. Buyer demand absolutely dropped off quickly. Anyone that's been trying to sell a home in the last 2, 3 months knows that. And as a result of demand dropping based on the number of homes that was for sale at the time, we've seen the impact in home prices. Here in Frisco, Texas, home prices are down 17% from their peak in April. They're still up 14% year over year, but they're down 17% from their peak in April as the demand just got taken out of the market by rising interest rates against those higher home prices. It just became unaffordable. But now we are starting to see mortgage rates stabilize to a certain extent. They're stabilizing higher than people want, but they are stabilizing. At the same point in time, we're seeing this softening in home prices due to the fact that the sellers were thinking that, oh, I can price my home up here and it's going to sell. And that just wasn't happening. But what isn't expected, or I should say what wasn't expected, is for supply to start to fall off as it has. It was expected that supply would continue to tick up and that we would end up with increasing supply against waning demand, which would cause the housing market to take a more significant downturn. Now, every single market's different. We're going to get into that in just a little bit, but every single market's different. What's happening here in Frisco, Texas is not going to be the same as Boise, Idaho, or Miami, or Charlotte, or anywhere else. So it's very, very dependent upon your local economy or your local real estate market because it's not universal. And also, as I mentioned, economy, there's a lot of uncertainty about the economy overall, which is absolutely going to play into that. But based upon the absolutely latest data and numbers, here's what some of the economists are starting to say with relation to home prices and what we are seeing with regards to inventories. I'm going to share my screen with you here. So right here we have the housing economist Lisa Sturtevant. I think I said her last name right. And what she's saying here is at the end of summer, after the end of the summer lull, and as mortgage rates stabilize, we may see a return of buyers on a relatively strong fall housing market. So what we know is that demand is still there, right? So there's definitely still demand out there. Not necessarily or nowhere near as much as there was, but there's definitely still demand. And as things start to settle down, we're starting to see traffic pick up again. We did see things go very, very slow towards the latter part of June into July and the first part of August, but we have seen activity pick up, especially in, for us out here in new construction. I was at some new construction homes and I could not believe the number of buyers out looking. It was absolutely packed. So we're seeing that for sure. At the exact same point in time, we now have Mark Zandi, who's the chief economist of Moody's, and they're generally very conservative in their forecasts. But here's what Mark has to say. I don't think national housing prices will decline in a meaningful way, but there will be some price declines across the country. Again, think Austin. Think Boise. Think your hottest markets during the pandemic. Those are the markets that are most susceptible to seeing home prices decline. Now, CoreLogic, their data is always a little bit behind, but here's what they're saying after their latest home price insights report. And they're showing this as they just released their numbers for July. So they're saying here that annual home price growth slowed for the third consecutive month in July, but remained elevated at 15.8% appreciation. Now, as 30-year fixed rate mortgages neared 6% this summer, some prospective homebuyers pulled back, helping to ease the overheated and unsustainable price growth, which we talked about earlier. Looking ahead, CoreLogic expects to see a more balanced housing market with year-over-year appreciation slowing to 3.8% by 2023, July of 2023. Notice slowing appreciation, not negative appreciation, not depreciation. While we have seen home prices decline month over month, year over year, we're still seeing prices increase. And it's expected that the amount of that increase will continue to fall. And here is CoreLogic are forecasting it may be 3.8%. I'm seeing other forecasts that are estimating that home pricing will go flat in 2023. Some markets down 2 to 5%, I've seen. And others are forecasting that prices will still increase anywhere between 3 and 6%, depending upon where that is. Now, again, as I stated right in the very beginning of this, home prices are directly related to inventory. So inventory is not going up as fast as we want, which is why I indicated we're starting to see some balance come back into the market or start to return. So here's the latest information from calculated risk. And again, this is national. I'm going to show you something for a local market in just 1 second. But this shows that inventory is still very low. While we are up 26.3% from where we were in the same week of 2021, inventory is still 5.4% lower than it was this same week in 2020 and 42.2% lower than where we were in 2019. So as you can see, while there are changes going on, there's not enough going on right now to indicate that the market's about to crash. I'm not saying it will. I'm not saying it won't. I personally don't think it will based upon the current data. But again, what's going to happen in the market at large, in the economy overall? We don't really know for sure, and that's going to be a big impact for it. One additional thing that I'm going to share with you at this time is some local information. Now, this is specifically for Frisco, Texas. And as I share this with you, this is a market report I put out each and every week. Okay. And so again, this is for Frisco, but at this top section of the report here, you can see how the market is doing at a glance. Gives you a nice little write-up, and it shows you where things are trending in all of these given areas. Okay, the area I wanted to focus on just a little bit for you is inventory. Okay, so the dotted line marks the 7-day average, and the solid line is a 90-day average. What you can see at the far right side here is that the 90-day average on inventory is starting to flatten. You can see it specifically how it's been dropping down on the 7-day average. This is where we are this week, September 2022. So here in Frisco, you can see how far behind we are, September of 2019. So inventory is still down here, just in excess of 50%. So a big decline, which means we have a long way to go in order to get back to the balance that we saw in the same month in 2019. But again, real estate is local. So if you're seeing this, I've got a link to this report directly below in the description. And at the top here, you can type in any city or zip code in the country. It can be local to Frisco. One of the Frisco zip codes could be Prosper, Salina, wherever you want it to be, or any city in the country. And you can see what the latest information or the latest data is specific to your market. So the big question is, with this information at hand, what does it mean for you if you're planning on buying or selling a home? How does this impact you? Well, let's start with sellers first, right? Let's look at the sell side. So why is inventory falling the way it is? Well, let's be honest. If you own a home right now, you're a seller and you don't actually have to move, why would you? You've probably sitting on a ton of equity that you've gained over the last few years, and you're probably holding on to a 30-year fixed rate mortgage in the range of 3%, 3.25%, maybe the high twos. So do you really want to trade that in for a mortgage rate of 5.5% to 6%? So the question becomes why? If you don't have to move, you're probably not going to. The only people that are the people that truly need to move. Job relocation, you have to downsize, or it's a good time to downsize and you're paying cash, so it doesn't necessarily matter. Or you've got a situation with maybe you're in a really small home and you've got a growing family and you absolutely need more space. There's always reasons why people need to sell and move. But for the people that are just thinking about doing it, unless there's a particular neighborhood or a particular type of home that you absolutely want, if you're just kind of on the fence, you're probably not going to put your home up for sale right now. You're probably just going to stay put for a while and see what happens. Completely understandable. Now, for a buyer, you're in a similar situation. If you haven't bought yet, there's a couple of things to consider now. On the plus side, a list price 6 months ago was basically where negotiations started. You have to determine how far above that you were willing to go. Now, if there's a list price, that's the absolute maximum you're probably going to pay for that home. You're not seeing bidding wars, right? You're not seeing multiple offers on the vast majority of properties. You can actually negotiate with the seller. There's a novel thing for the past couple of years, isn't it? So it's a very different market. But again, you might be saying, well, prices are coming down month over month, right? So how low will they go? I don't want to buy now if they're going to be lower next month or the month after. And that's honestly a decision that only you can make. What it really comes down to is, if you've got your heart set on an ideal home and that perfect home gets listed in the next week or 2 weeks, how important is it for you to be able to get that particular property rather than wait and settle for something else if the right home doesn't come on the market? Just an observation, just saying. On the flip side, and this goes for people potentially selling right now or buyers, you've got new construction. A little bit of the best of both worlds right now, especially here, right? There's a ton of new construction going on right now, and the builders are offering some substantial incentives. They're offering discounts in the design center. They've reduced the price on many properties, and they're definitely offering incentives with regards to financing. The builders here are staying ahead of the curve. Sales are brisk, but they are staying ahead of the curve. You've got them offering interest rate buy downs. So for instance, there's one builder that's offering a 2.99% fixed for the first year, 3.99% fixed for the second year, and then 4.99% fixed for years 3 through 30, all right, or 4 through 30. So in a case like that, that's not a bad deal. You're still getting a lower mortgage rate, but you're being able to get the home that you're actually wanting to get into. But again, each and everyone's situation is different. So hopefully that helps provide a little bit more insight into where we are currently. And again, if you'd like to get updates like this more often, please go ahead and subscribe to this channel. Click the little bell icon to be notified. As I mentioned earlier, I do put out a new video at least once every week with all of the latest data and the trends on what's going on in an effort to help you make the best decision for you and your situation. So if you have additional questions or want to reach out, schedule an appointment to talk, please do so. You can reach me at 469-296-5230 or send an email to Andrew@theandrewsmithteam.com.